Trying to decide between SIP and lump sum? Well, whether you are new to investing or looking to refine your approach, choosing between lump sum investment and an SIP can be crucial. Today, we'll break it all down for you so that by the end of this video, you'll have a clear idea of which method aligns the best with your financial goals. So, first up, lump sum investment. What does it mean? Lump sum investment is when you invest a large chunk of money into an asset or a mutual fund all at once. Imagine this scenario: you have received a bonus at work or have saved up a large amount of money over time, say 6 lakhs. So instead of investing a bit each month, you invest all the 6 lakhs right now. Here's how it works. Let's say you invested that 6 lakhs into a mutual fund that promises 12% return over 5 years. After 5 years, that investment could grow around 10.57 lakhs. That's the power of compounding, where returns generate even more returns over time. However, lump sum investing can be tricky. If you invest during a bull market, your returns will be higher. But if the market dips right after you invest, it could take a while to recover those losses. For example, let's say you start investing from Jan 2024 to Jan 2025 and Nifty rises by 15%. And then from Jan 2025 to Jan 2026, it drops by 20%. And finally, from Jan 2026 to Jan 2027, it again rises by 30%. Now, let's consider 3 possible instances you choose to make your 1 lakh lump sum investment, which is Jan 2024, 25, and 26. If you invested on these dates, then by 2027, you'd have around 1.19 lakhs, 1.4 lakhs, and 1.3 lakhs respectively. Notice the difference in returns just by shifting the investment date by 1 year. The worst case scenario is investing during Jan 2025, and by the end of the year, your investment of 1 lakh would become 80,000. And out of fear, you might withdraw all your investments and never recover your losses. This is the risk with lump sum investments. Now, let's talk about SIP, or Systematic Investment Plan. Think of SIP as the opposite of lump sum. Instead of investing a large amount of money all at once, SIP allows you to invest a smaller fixed amount regularly, say each month. It's a disciplined way of investing. For example, instead of investing those 6 lakhs all at once, you invest 10,000 each month for 5 years, while it's growing at 12% per annum. Now, after 5 years, your total investment would still be 6 lakhs, but your investment value would be around 8.24 lakhs. Now, this amount is lesser than the lump sum investment amount, which was 10.5 lakhs, but you're able to manage market volatility with rupee cost averaging. Let's understand rupee cost averaging. With an SIP, you invest a fixed amount each month. This means when the market is down, the price of your investments will be low, so you'll buy more units. Similarly, when the market is high, you'll buy lesser units. This averages out your overall cost of investing and reduces the impact of market volatility. Choosing an SIP or a lump sum investment depends on your goals and your risk appetite. But here's what we can tell you. SIP is ideal during falling markets because it lets you take advantage of the rupee cost averaging. When the market is down, your investments buy more units at lower prices, which means when the market recovers, the overall value of your holdings increases. This strategy reduces the risk of trying to time the market and allows you to spread your investments over time. On the other hand, lump sum investing is better for long-term goals, typically 10 years or more. By investing a large amount all at once, you benefit from the power of compounding, where your returns grow on both the original investment and the accumulated returns over time. While short-term market fluctuations may occur, a long-term horizon usually leads to higher growth, as markets tend to rise over extended periods. One thing to remember is that tax implications in India are similar for both lump sum and SIP. Both are subject to the same capital gain tax rules. Whether you choose a lump sum or an SIP, the returns you earn will be taxed under short-term or long-term capital gain tax, depending on how long you stay invested. So tax-wise, both the methods are on par. Now, I know it's not always easy to choose between lump sum and SIP. This is where tools from StackWealth comes in handy. StackWealth offers calculators and investment comparison tools to help you figure out which strategy might work best for your financial goals and market conditions. You can analyze different scenarios, compare potential returns, and make an informed decision about which method suits you the best.
We're going to explore 2 different market scenarios. One where the market starts off bearish and later recovers, and another where the market rises steadily before cooling off. We'll compare how SIP and lump sum investments perform in each case. So, in the first scenario, in an initially bearish market, What I've done is consider a 5-year investment time frame. For the first 4 years, I assumed that the mutual fund I selected would decrease by 1% every month. And in the last year, it would recover and increase by 2% per month. So what I'm going to do is I'm going to start the investment journey on November 1st, 2016, and my end date is November 1st, 2021, completing the 5-year period. To explain further, during the first 4 years, the NAV decreases from 100 to 99 to 98, reducing by 1% each month. By September 1st, 2020, we hit the lowest point. After that, the NAV starts increasing by 2% every month, like from 62 to 64 and so on. So what we're going to do is we're going to consider an SIP and lump sum case. In the SIP case, we're going to be investing rupees 10,000 every month for 5 years, which totals to an investment of 6 lakh. So to be fair, in the lump sum scenario, we're going to assume investing that 6 lakh as a lump sum in the beginning stage. So now with this bearish market scenario, at the end of the 5 years, my total investment of rupees 6 lakh, which was an SIP, will have grown to a value of 6.46 lakhs or around that amount, resulting in an XIRR of 2.94%. However, if I had made a lump sum investment in the beginning during the bearish period and the recovery phase, my absolute returns would have been minus 16.9% or with a CAGR of minus 3.63%, both being negative. So this demonstrates that SIP performs better in a falling market. Now let's analyze the bullish market scenario or a rising market. Now we'll do the reverse. In an initially bullish scenario, we're going to assume a 2% monthly increase for the first 4 years, followed by a 1% decline per month in the final year. So starting with the NAV of rupees 100, it is increasing to 102 the next month and then 104 the month after that and so on. Now it'll reach a peak of 248 by September 2020, and then 2020 onwards it's going to start declining. So when it reaches the peak of 248, it will start declining the next month by 246 and then 244 and so on. Now, in this scenario, we will have invested 10,000 rupees per month through an SIP for 5 years, totaling to 6 lakhs. At the end of the period, the value of my investment would be around 7.88 lakhs, giving me an XIRR of 10%, which is quite good. But if I had invested that entire 6 lakhs as a lump sum in the initially rising market, my final value would be 12 lakhs 96,000, giving me an absolute return of 116% and a CAGR of 16.65%. Now, if this technical analysis was too complicated for you, we're going to sum it up in a very simple way. Basically, if the markets are going to rise, a lump sum investment tends to do better. If the markets are going to fall, then an SIP investment does better. Why does an SIP investment do it better? Because it spreads out your investment, thereby reducing the risk. Now, what you need to know is that you can't always time the market really well. So that's why new investors prefer to go with an SIP, because a lump sum investment is usually a very big bet. And rather than taking that bet, you can go with an SIP, which is a more safer and usually a wiser way of investing. So, what's the bottom line? Basically, if you have a large sum to invest and the market looks promising, lump sum could be the right choice for you. But if you prefer a steady, disciplined approach that spreads out your investment and reduces the risk and also doesn't take market timing into factor, SIP would be the better choice.
So, what's the bottom line? Well, if you have large sum to invest and the market looks promising, then lump sum could be the right choice for you. But if you prefer steady and disciplined approach that spreads out your investments and reduces the risk of timing the market, then SIP is the better option. Both methods have their pros and cons, and the right choice depends on your financial goals, risk tolerance, and the market outlook. And if you're still unsure, remember that there's no rule that says that you can't use both strategies. A balanced approach where you invest a lump sum when the market is favorable and continue SIPs over time, this approach might just give you the best of both worlds.
Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching, and goodbye.